Imagine building one of the world's largest telecommunications companies, only to lose almost everything in less than 3 years. At its peak, Marconi was worth more than £34 billion. It employed tens of thousands of people. Its equipment powered telephone networks across the world. Investors believed the Internet would create unlimited demand for telecom infrastructure. The future appeared almost guaranteed. Then, the company made one enormous bet. It borrowed billions of pounds to buy more telecom businesses, just as the greatest technology bubble in history reached its peak. When that bubble burst, the customers Marconi expected to buy billions of pounds of new equipment simply stopped spending. Revenue collapsed, debt remained, and one of Britain's most celebrated engineering companies entered one of the fastest corporate collapses in modern history. The shock wasn't simply financial. For generations, Marconi had represented British innovation. Its roots stretched back to Guglielmo Marconi, the inventor whose wireless communication technology helped transform global telecommunications. Over the 20th century, the company evolved into one of Britain's most important engineering businesses, developing telecommunications equipment, network infrastructure, military electronics, and advanced communications systems used by governments and telecom operators around the world. By the late 1990s, the Internet was expanding at extraordinary speed. Mobile phones were becoming mainstream. Businesses rushed online. Telecom companies everywhere believed demand for network capacity would continue growing almost without limit. Investors reached the same conclusion. Telecommunications became one of the hottest sectors in global financial markets. Company valuations soared. Acquisitions accelerated. Every major telecom supplier raced to become bigger before competitors did. Marconi's management believed the industry was entering a once-in-a-generation opportunity. If they expanded aggressively, they could become one of the world's dominant telecommunications equipment companies. If they waited, they risked being left behind forever. The decision that followed wasn't simply about buying another company. It was a massive bet that the telecom boom would continue for years. Instead, the company had unknowingly placed almost its entire future on the final stage of the largest technology bubble the world had ever seen. To understand why Marconi collapsed, you first need to understand what telecom companies were buying. Marconi didn't sell mobile phone plans. It didn't own telephone networks. Its customers were the companies building them. Telecom operators like BT, Deutsche Telekom, France Telecom, AT&T, and dozens of others constantly invested billions building communication networks. Every new mobile tower, every fiber-optic cable, every internet exchange required sophisticated equipment. Marconi supplied much of that technology. Imagine a property developer building a new city. They don't manufacture the cranes, the concrete, or the electrical systems themselves. Specialist suppliers provide the infrastructure. Marconi played the same role for the telecommunications industry. As internet traffic exploded during the late 1990s, telecom operators believed they needed dramatically larger networks. Every forecast pointed in the same direction: more internet users, more mobile phones, more data, more network capacity. If telecom operators planned to spend $10 billion expanding infrastructure, companies like Marconi expected enormous equipment orders. The entire industry became locked together. When telecom operators invested, equipment manufacturers prospered. When operators slowed spending, suppliers immediately felt the impact. This dependency became critically important because Marconi wasn't simply betting that more people would use the Internet. It was betting that telecom companies would continue spending billions upgrading networks year after year. Management believed this investment cycle had only just begun. To capture as much of that opportunity as possible, Marconi began buying other telecommunications businesses at extraordinary speed. Each acquisition increased its product range, expanded its customer base, strengthened its global presence, but it also dramatically increased the amount of debt sitting on the company's balance sheet. The strategy appeared brilliant as long as telecom operators continued investing. Everything now depended on one assumption, that demand for network equipment would never slow. It was an assumption shared by almost the entire telecommunications industry, and it would soon become one of the most expensive assumptions in corporate history. By 1999, the telecommunications industry had become one of the hottest investment sectors in the world. Investors believed the Internet would change everything. Telecom companies rushed to build larger networks. Billions of pounds flowed into fiber-optic cables, mobile infrastructure, Internet backbones, and data transmission systems. Every company feared being left behind. Marconi feared it too. Rather than expanding slowly, management decided to grow through acquisitions. In 1999, Marconi agreed to acquire Reltec, an American telecommunications equipment manufacturer, for approximately £1.3 billion. Only a year later, it made an even larger move. In 2000, Marconi purchased 4 systems for approximately £2.8 billion. Together, the acquisitions dramatically expanded Marconi's presence in North America, broadened its product portfolio, and strengthened relationships with major telecom operators. Wall Street applauded. Investors believed Marconi was positioning itself to become one of the world's dominant telecom infrastructure companies. But there was one problem. Most of these acquisitions were completed at the absolute peak of the telecom bubble. Company valuations had reached extraordinary levels. Competition between buyers pushed prices even higher. Marconi wasn't simply buying businesses, it was paying bubble prices, using borrowed money based upon future growth that everyone assumed would continue. Imagine buying several investment properties during the hottest housing market in history, using large mortgages because you believe prices can only rise. If values continue increasing, you look like a genius. But if the market turns, both the value of the properties and your ability to repay the debt can collapse together. Marconi had unknowingly placed itself in exactly that position. Its future no longer depended only on selling telecommunications equipment. It now depended upon one far more dangerous assumption, that the telecom boom would never end. Then, the assumption failed. By late 2000, telecom operators around the world suddenly changed their priorities. After years of aggressive expansion, many had accumulated enormous debt of their own. They had spent billions purchasing 3G mobile licenses, laying vast fiber-optic networks, and building Internet infrastructure far faster than customer demand actually required. The networks existed, but much of that capacity remained unused. Imagine building a 10-lane motorway only to discover that traffic only requires 4 lanes. There is no reason to immediately build another motorway. The same thing happened across the telecommunications industry. Telecom operators didn't need more equipment. They needed time to earn a return on what they had already built. Almost overnight, capital expenditure collapsed. Projects were delayed. Expansion plans were canceled. Equipment orders disappeared. For Marconi, the effect was immediate. Its customers weren't consumers buying mobile phones. Its customers were telecom operators. The moment those operators stopped investing, Marconi's revenue began falling at extraordinary speed. Factories that had been expanding production suddenly had fewer orders. Warehouses filled with unsold equipment. Sales forecasts were repeatedly downgraded. Management initially believed the slowdown would be temporary. They expected investment to recover within months. Instead, the downturn accelerated. Every canceled infrastructure project meant another lost equipment order. Every delayed network upgrade reduced future revenue. The acquisitions that had looked brilliant during the boom were now sitting on a balance sheet supported by shrinking sales. Debt repayments hadn't changed. Interest costs hadn't changed. Only customer demand had. Marconi had spent billions preparing for a future that suddenly stopped arriving. By 2001, Marconi was no longer trying to become the world's leading telecom company. It was trying to repair its balance sheet. Revenue continued falling, but debt remained. Every month, interest payments consumed cash that the business could no longer easily replace. Management urgently searched for solutions. Factories were closed. Thousands of jobs were eliminated. Operating costs were cut. Non-core businesses were placed up for sale. The objective was simple: generate cash, reduce debt, and restore investor confidence before liquidity became critical. But there was one problem. Almost every telecom company was facing the same downturn. Potential buyers had become cautious. Asset values had fallen dramatically. Businesses purchased for enormous prices during the boom were now worth far less. Imagine buying a commercial building for $10 million during a property boom, then discovering the market now values it at only $5 million. Selling it no longer solves your financial problem. It simply locks in a massive loss. Marconi found itself in exactly that position. The acquisitions that had once impressed investors had become assets nobody wanted to buy at the prices Marconi needed. Meanwhile, credit rating agencies became increasingly concerned about the company's growing leverage. Banks watched the deteriorating balance sheet closely. Investors lost confidence. Marconi's share price collapsed. Billions of pounds in market value disappeared within months. The company's access to new financing became increasingly limited. This created a dangerous financial cycle. Lower revenue reduced cash flow. Falling cash flow weakened confidence. Weaker confidence reduced access to capital. Less capital made restructuring even harder. Every attempt to save the business became harder than the one before. Marconi wasn't running out of technology. It wasn't running out of engineers. It was running out of financial flexibility. The company had borrowed for a future that no longer existed. And now, the balance sheet itself was becoming the company's greatest enemy. By the summer of 2001, Marconi's crisis had become a race against time. The company wasn't trying to return to growth. It was trying to avoid running out of money. Every week, banks, credit rating agencies, investors, customers, and suppliers watched the company's financial position more closely. Confidence became almost as important as cash itself. Large telecom operators hesitated before placing new orders. They wanted reassurance that Marconi would still exist to support the equipment years into the future. Banks became increasingly reluctant to extend additional financing. Investors continued selling the shares. The company found itself trapped. The weaker confidence became, the harder it became to restore confidence. Management announced another major restructuring. Thousands more jobs disappeared. Factories were sold. Business divisions were broken apart. Historic assets built over decades were liquidated simply to keep the company alive.
but the balance sheet had already been damaged too severely. On 10 July 2001, Marconi shocked financial markets by warning that its profits would be dramatically below expectations. The announcement triggered one of the largest single-day collapses in British corporate history. Its share price fell by more than 50% in a single trading session. Billions of pounds in market value disappeared within hours. For investors, the warning confirmed their greatest fear. The telecom boom wasn't temporarily slowing, it had fundamentally ended. Over the following months, Marconi continued selling businesses, raising cash, and negotiating with lenders. But every asset sale made the company smaller. Every restructuring acknowledged that the original strategy had failed. By 2002, the business could no longer support its enormous debt burden. A comprehensive financial restructuring became unavoidable. Banks, bondholders, and creditors effectively took control of the company. Existing shareholders, who at once owned one of Britain's most valuable technology companies, were left with only a tiny fraction of their original ownership. Marconi's telecommunications business survived, but the company investors had known had effectively disappeared. It wasn't destroyed by a single product failure or a superior competitor. It was overwhelmed by debt, after betting that one extraordinary investment boom would never come to an end. Marconi's collapse marked the end of one of Britain's greatest engineering companies. But it also changed the telecommunications industry forever. The Internet didn't stop growing. Mobile phones continued spreading across the world. Broadband adoption accelerated. Data traffic exploded. The demand that investors had predicted eventually arrived, just not when they expected. The real mistake wasn't believing in the future of telecommunications. It was believing the future would arrive quickly enough to justify the debt taken on today. Following the restructuring, Marconi's remaining telecommunications business became dramatically smaller. In 2005, it was acquired by the Swedish telecommunications giant Ericsson. One of Britain's most iconic technology companies effectively disappeared into another global business. For shareholders, the outcome was devastating. Investors who once owned shares in a company valued at more than $34 billion saw almost all of their investment disappear. Employees lost thousands of jobs. Factories closed. Research facilities were sold. A company that had helped shape modern communications was dismantled over only a few years. Marconi's collapse also became a permanent case study in business schools, investment firms, and corporate boardrooms. It demonstrated that even when a long-term prediction is correct, timing can determine whether an investment creates enormous wealth or catastrophic losses. The Internet revolution was real. The telecommunications boom was real. Global demand for network infrastructure did eventually become enormous. Marconi simply expanded too aggressively, borrowed too heavily, and paid too much before that future had fully arrived. Marconi wasn't ultimately defeated by better technology. It wasn't defeated because people stopped using the Internet. And it wasn't defeated because telecommunications became obsolete. It was defeated because management financed tomorrow's opportunity using today's debt and expected tomorrow to arrive much sooner than it actually did. The world eventually needed exactly the networks Marconi believed it would. By then, Marconi was already gone. Its technology helped build the connected world we live in today. Its collapse became one of the clearest reminders that in business, being right about the future isn't enough. You also have to survive long enough to reach it.